Hey, good morning, everyone.
Morning, Professor.
Hey, good morning. Who was that? Randy or
Good
was it
morning,
Darlene.
Professor.
Darlene? Darlene, how are you? Good morning, Randy. How's everybody?
I'm
Happy New
fine.
Year. Good, good. Happy New Year, first of all.
Happy New Year to you too, Professor.
Well, thank you. Thank you. Let me just adjust a couple of settings here. First, I will need to uh, put that into gallery view, and let me share my screen. Alrighty, so now you can see my screen. So, well, first of all, welcome to Finance 100, Principles of Finance. Now, I sent out email a couple of days before, um, and the Blackboard was um, out of service for a while, actually. You may have not noticed, but until between like Christmas and the 28th, almost 29th, Blackboard was out of service because they were doing some maintenance. So I sent out the earliest I could send out any email was on the 29th. I believe on the 30th or 29th or 30th. Only on the 30th I was able to send out emails. So if you got my email, and that's why you're all here. Um, uh, the first thing, okay, so let me check how many people are in today's forum. Uh, this was okay. So I see only how many people? Um, I see only 5 people in the discussion board. And in my instruction, I made it very clear that you need to you need to first sign into today's discussion board, right? The schedule every day we will have you will see new forum open. You will see new forum open up in the discussion board every day, and the purpose of the forum um, is to have it as our sign-in sheet, okay? Our digital sign-in sheet. So that will be your proof, digital proof, physical proof of your attendance. In other words, that's your digital footprint. So to validate your attendance, you must sign up in the discussion board and um, declare your um, declare your attendance there. It's just creating a thread, right? By creating a thread, you will establish your proof, physical proof of attendance. Okay, so I see 9 people, 9 people in the collaborate, but I could see only 5 people. So if you haven't done it yet, please uh, create your thread, attendance thread, so that it would validate your attendance, so that you would have a physical proof of your attendance. Okay, and that's the only way you can validate your attendance. All right, and also let me take you quickly to a couple of things. You don't see everything now because I have already built in everything there, and they are automatically, they will automatically go out uh, per schedule. Okay, so let me enter student view mode. currently all you can see are like in the announcement. First of all, you will need to check the announcement. Of course, the first thing you need to do is to go to the discussion board. Okay. Once you come into class every day, the first thing you will need to do is to go to the discussion board. It's taking a little time. I think the Blackboard is slow, clearly, today. And I just showed you what's going on in the, what you need to do in the discussion board. So I'm not gonna, okay, it's taking too much time, so forget it. Let me just quickly point to a couple of things. Of course, this is the welcoming message, but it pretty much, explains. Okay, let's give me all right, doesn't work. Okay, so here today you can see, as I said, the first thing you need to do is to go to the discussion board and find today's forum. And once you go into today's forum, okay, first of all, you will see my thread, right? And then it's basically, if you click on it, it's basically telling you the instruction for today's lecture, right? Where you can find today's lecture. But I made this available already one day ahead, so that you can watch these videos just like assigned reading, required reading for the class, right? And this is the main lecture. Okay, I've been telling you. So he says, please go to the course materials, right? ROI videos part 1 through part 6. So you go to course material. And please bear with me. The Blackboard is quite slow today. And then what you can see today is only one topic. But there are 7 topics. There are 7 topic folders like this throughout the semester. I mean, throughout the winter session. Just like the regular semester, we'll cover all 7 topics, and they are not. There's a lot. I mean, just for today, you have only. For today, six videos, ROI part 1 through part 6. That's today's lecture, which you should have watched already yesterday before you come to. And then you have other, ROI and macro, part 1 through part 5. These are not videos, these are just the links. So these are for tomorrow, but they must be made available today so that you can watch these today to prepare for discussion tomorrow, right? Understand? So just like the required reading, pre-assigned required readings, you must watch these videos ahead of the class. So during the class, we can only have a discussion about it. So it's like so the collaborate session is like an reflection. It's a reflection and review of the main lecture. That way it will reinforce your understanding of the topic, right? And the material. So back to today's forum. Okay, and I see, yeah, then all of those 9 people that are in the collaborate. So I see 10 people, and so still one person is not here yet. So if you're not here, please do it ASAP. As I said, it's the only physical proof of your attendance, right? Later on, because this session will be gone. Oh, although I'm recording it, but the session will be gone. Okay. We need some kind of, hard copy, or, physical hard copy printout, or hard copy digital footprint, right? So this is it. So please, don't forget to do this. All right. So that pretty much, explains what you need to do. The protocol, the standard protocol for this class. Once you come to class every day, the first step, report attendance. Second, then come to, of course, report attendance and read the instruction for today's lecture videos, okay? Which are actually pre-assigned, right? So for tomorrow, you saw the you already in the course materials folder. You saw what we are going to do tomorrow already, right? Which is today's assigned videos. Now, once you're done, then you come to collaborate, and of course we are in collaborate already. But before, let me. Oh no. Assignments. Your exams. Assignments and exams will be all posted here when it's time. It's already built in. It's going to be turned on. It's going to be activated. It's going to be triggered by schedule. Okay, it's not visible to you yet, but it is visible to me. It's all built, pre-built, and it's going to be triggered by the schedule. Okay. And you will be notified in advance. And then get back to announcements. Now, class protocol, you got this by email too. So attendance is 10% of your grade. Actually, if you have noticed from the course information, let me take you to the course information, right? And then there is the syllabus. If you click on it, well, in the past semesters, if you click on the file, posted file there, it's going to automatically download. But now it's not going to download. It's not going to download automatically. It's going to just open it like this. But this is standard syllabus, so this is standard syllabus. So this is based on a regular semester. But all of these topics, right? It says 6 topics, but they are 7 topics because I broke up topic 5 I broke it up into 2. So there will be topic 5, topic 6, and the second part of risk analysis and risk and return will be covered after topic 6. And here's the for the breakdown. But what I want to point to you is, I think this is this needs to be this will need to be revised, because this is old criteria. But what I want to point to you is the grading criteria, which is basically exam policy. There will be two quizzes, right? Quiz 1 and quiz 2, which will be 20% of your semester grade each, right? So each quiz 1 and quiz 2 will count for 40% of your grade, and then midterm and final will each count for 25%. So then they will be 90%, and the other 10% comes from attendance and participation. But it's not just 10%, it's going to be 10% plus 10% and above. Why? Then the total is not 100%. Total can be more than 100%. Yes. Why? Basically, attendance and participation is designed to be 10%, but I give more weight to the participation. So that brings us back to now. So out of the 10%, right? And they will be exactly 10 points. Exams will be weighted by those weights, right? So they will be scaled down. If you got 100 in any exam, if you got 100 in the midterm and final, that will be only 25 points out of 100, 25 points, because out of the total semester points of 100, right? I told you midterm and final are 25% each. So if you got 100 in the midterm, there will be 25 points. If you got 100 in the final, there will be 25 points. And quiz 1 and quiz 2, if you got 100, will be 20 points each. That will add up to 90 points. And then 10 points come from attendance and participation. Now, attendance is basically 5 points, because we are meeting, think about it, we are meeting Monday through Friday, which is 5 days a week, and 3 weeks. That's 15 sessions, right? 15 sessions. So if each day for presence, you will get 0.33. And of course, if you multiply it by 15, it's going to come to like 4.9, close to 4.95, or almost 5 points. Then the other 5 points, or more than 5 points, because it depends on how many great answers you give or good answers you give, right? So basically, let's say the other 5 points will be filled by participation. But as I said, this can be more than 5 points, because I will be asking you, I will be prodding you, actually. I will be prodding you with, or even pestering you with, bugging you with, questions sometimes, or bombarding you with questions sometimes during the collaborate session. And if you give me a great answer, I will give you 2 points. Great answer. That's really great answer. And if you give me a good answer, that will be 1 point. An average answer will be given, 0.5. So if you give me just 5 good answers, that's already 5 points. If you give me 20 good answers, that's going to be 20 points. Without, it's not going to be scaled down. It will be just raw 20 points, right? Suppose you give me one great answer every class, one great answer every session. And we have 15 sessions, right? Over 3 weeks. There will, and if you give me one great answer every session, that's going to be 30 points already, right? Without being scaled down or without being weighted, there will be raw 30 points. So think about it. Then if that is the case, with perfect, attendance of 5 points, that's going to be 35 points. And suppose somehow then, if you have done all, if you got 100 in all of the exams, then that's going to be this is going to be, way out of proportion, right? In other words, you have already 90 points from all the exams, and then plus 35, it's going to be 125. Normally, it should be 100, but it can go to even 125, right? And this will come in very handy. I mean, just in case of some extreme emergency, let's say you missed, you had to be hospitalized or whatever, you had an accident or whatever, you missed the exam. And then normally, if you can make it up within, I would give you makeup opportunity, but if it is too late, let's say, you missed the first quiz, and then it's been already 2 weeks. It's been more than 1 week. I'm not going to give you a makeup opportunity. Especially, there can be no makeup opportunity for final, because final, at the end, once the winter session is over, 24th is the last day, and I have to wrap it up, and must report grade within 48 hours, and to report grading, to grade within 48 hours, and to complete reporting, then I have to have the data. I have to have compiled the data of everyone, right? Within, at least, 12 hours of the, within 12 hours of the end of the winter session. So if the data comes in after that, I can't use it. So I have to have the data exactly by the end of the semester. All the data must come in by the end of the semester, right? So if you missed the final, then there's no makeup. There's no time for makeup. I mean, even during the regular semester, there's no time for physical time for makeup for final. So you have to do it. You have to submit it by exactly that due date. But in that case, if you have given me like 20 great answers, 10 great answers. Did I say 10 great answers? Or 15 great answers? 15 great answers, right? That's 30 points already. That comes in very handy. It makes up for the exam that you have missed, more than make up for that, because as I said, midterm and final is only 25%, and even if you got 100, that will translate into 25 points in midterm and final. So if you got 35, that already more than compensate for that missing 25 points, and still leaves you with 10 extra points. Okay, and the reason I'm giving so much weight to the participation point is when you answer, when you give me the answer, when you answer my questions, that proves that you have really got it. I mean, some people, and this can be this can't be disputed. When you give me the correct answer, right, and great answer, this can't it can it cannot be disputed or denied that you've got it. Because sometimes the exams, there's no way I can every time every time, sometimes people, some students, cheat. They uh, and practically it's not easy to check if the student really got it because the student understood it, or if the student just got lucky, or there's no way to it's not easy to discern the difference. But if you give me a good answer, that's an indisputable proof that you got it, right? So that's why I give a lot of weight. I try to give uh, a lot of weight to, and the weight that that weight uh, depends on the quality, the number of answers, and the quality of answers that you give, right? So then there is no, it's not, there's no way to dispute it, right? There's no way to dispute it. All righty. So with that being said, so let's go to one more thing I just want to when you're sending an email to me, do not send it to my BMCC email, but send it to my Yahoo email, because BMCC email somehow, whatever is coming from the Blackboard, right? Whatever is coming from the Blackboard related uh, accounts, those emails go automatically to the junk mail folder. And if it goes into the junk mail folder, uh, it's not easy to only filter out only the bad emails, really the junk emails, and only sort out um, the emails from you. Okay, so sometimes if you send it to my BMCC email, they chances are you won't be able to, those emails. The chances are they won't get discovered. They will go undiscovered most of the times, because I get a barrage of junk mail every day, and so after if I don't um, diligently comb through all those emails every day, um, and I practically I have no time to do that. They will get just piled up in junk mail folder and periodically get purged. So if you send email to my BMCC uh, account, chances are they won't get discovered. So please don't send it to my BMCC account, but send it to my Yahoo email, please. And one more thing, um, don't compose new email every time. Just reply to your old, if you send an email to me, then I will reply to that. And then if you need to send another email, just reply back to the email, right? Then that way all the emails will stack up in one in a single thread, right? On the one thread, uh, and then all the emails will stack up in chronological order. So then I can easily research what was if you're replying back to me to the previous email that you sent, um, I can go over all the history of the email, right? That way I know what was the problem, right? And what was the issue. Okay, if you send separate emails, then they will not be organized as one group. They will be all scattered all over, right? And then it will be, again, then it's a matter of your time management and efficiency. If the emails are all separate, right, disjointed, then I will have to search for all the emails from one particular student to understand the history of that issue. But if they are all stacked up all together on the one title or on the one email thread, then I can easily review and understand the issue with that, or grievance. If the email is mainly about the grievance, right? Okay. All right. So then that pretty much explains the the protocol of this class. So let me go to let's go to okay, not this one. Where was I? Oh, okay. Let's go to today's lecture, right? As I said, what we do in the Collaborate is to reflect on the pre-assigned main lecture videos. Okay, so here's part 1 through part 6. So first of all, these are files that you need. These are work files, basically. This one is the PDF file, and this one is Excel file. And this one is, I believe this is also an Excel file, but we're going to use it later. But for now, I want you to download these 2 files, okay? This is a PDF file, so it may, without downloading, you can review what it is, right? You can review as it is. But this is an Excel file, so it will have to be downloaded, okay? So please download those files first. So let me start with what return on investment is. Now, first of all, the title of the first topic is return on investment, ROI, return on investment. And this is basically, think about it, ROI, return on investment, is the main theme of investing, right? Also, it's the main theme of finance. Why? Because what is finance? Of course, finance has, when we say finance is also a verb, right? Because we say, the project is financed by such and such. What does that mean? When we say the project is financed by something, by such and such entities, what does that mean? Anyone?
Can you repeat that question, Professor, please?
Yeah. The question is, when we say the project is financed by something, right? What does that mean?
That's the capital that the business used was financed by the bank or maybe an investor.
Yeah. We already know, in everyday use, right? In everyday usage, the word finance is also used as a verb, and it means that's how you raise the capital. Isn't it right? That's how you funded it. That's how you
Correct.
raised the capital needed, right, to fund the project, right? So yeah, Leslie. So that
Leslie.
was Leslie, right? Right,
Yes.
Leslie. Yeah,
Leslin.
Leslyn. I'm sorry, Leslyn.
Yeah.
Yeah, Leslyn. So I'm gonna give you 0.5 points for that. Um, every answer you give me, right? Unless it is a poor answer, you'll earn participation points. So this is this is the way to rack up extra points, right? Now, yes. So the word finance, of course, means the various methods and various means to raise capital. But also, so there is corporate finance. Corporate finance is mainly about how corporations, firms raise capital to fund the project it undertakes, and how to maximize the efficiency of the capital projects that they undertake, and maximize the return from it. So main theme, if you think about the main theme of the discipline of finance, or the subject of finance, is how to maximize return, right? Return means what? Return on investment, because a project is the undertaking, right? The project is um, an investment that the company undertakes, and also for an individual, not for corporations, but for individuals.
I'm sorry, Professor. Can I ask a question?
Yeah, sure.
Does the return on investment also includes the profit?
Yeah, profit is part of the element. Profit is an element of return on investment.
Understood.
Okay.
Yeah, got it.
Yeah. So we're gonna be.
Professor, does that mean
Yeah.
return
Hold
investment
on.
in the long run?
Say that again.
Does that mean return investment in the long run?
Or it can mean return on investment in the long run or in the short run.
Okay.
Okay. I'm gonna get to that. I'm gonna get to that shortly. And it looks like somebody dropped a line in the chat: making money. return on return on investment means making money. Yes, but making money is kind of too broad. It's too it's kind of vague, because we need to specifically define it. I'm gonna get to that later. Uh, uh, yeah, it means investing. Um, it's return on investment, so it involves investing, but the focus is on the return. Okay, so what is so let's think about it. If I invest, let's say $1,000, and invest in what? So there must be investment instrument, right? Instrument of investing, right? And as an individual, you will be investing in investment instruments, so generally stocks and bonds, right? Those are only financial instruments, There are non-financial instruments that you can invest in. For example, real estate, right? Financial market, so you might wonder, uh, with $1,000, how can I invest in real estate? Of course, with $1,000, you can't. But the point is, investing is an activity that you do to harvest the fruit in the future. Isn't it right?
Yes.
Yeah, the fruit is in the future. So, for example, real estate could be a good example. I mean, if you have, let's say, $500,000, you buy a house or, a commercial property, and this commercial property or house will, in the future, I mean, just think about a house. Um, you buy a house, and let's say, the house is, $150,000. You cannot buy a house for $150,000 these days, but about 20 years ago, um, uh, probably not in the five boroughs, but you could buy a house in the Westchester County or in Hudson County, New Jersey, or some about 20 years ago, you could buy a house, not a very good house, but probably 3-bedroom, 1-bathroom house, uh, about 20 years ago in the surrounding counties, right? In the suburban, surrounding counties of greater New York area. But suppose how much those homes would be worth today? Probably at least about $300,000 or even more. Could be $500,000. That was 20 years ago when you bought it. 20 years later, there has been what? Price appreciation, right? There has been price appreciation, right? So let me use, I think this is a good time to use.
Is it inflation?
No, no, no. I mean, inflation could be a part of it, but even without inflation, still the house value would go up as long as there is a. Let me open a new one. Think about it. What is the factor that would affect the house value? Suppose okay. $2,002. You see this? Do you see the? Please let me know. You see the whiteboard? Do you see the whiteboard?
Yes.
Yes.
Okay, good. So this means price in 2002, right? Price of the house in 2002, it was 150K. And at the end of 2021, so that's going to make it 20 years because this is the end of 2000. Let's see. I should make it end of 2001 to make it exactly. Oh. So at the end of 2001, right? You bought a house and you paid 150K. And 20 years later, so that's the end of 2021, the house value was, let's say, 500K. Now the house value appreciated a lot. You can say this is a lot. This is more than, this is more than threefold. Isn't it right? This is more than threefold. 3 times this is only 450. Isn't it right?
Yeah.
Isn't it right?
Yes.
Yeah. And so it's more than threefold increase in house value. This is called price appreciation. Of course, price appreciated, right? Price appreciation. But another, the actual portion of appreciation is 350K. Isn't it right? The actual portion of increase. Isn't that right, everyone? No?
Yes.
Yeah, of course. The increased portion is 350K, right? And that's called capital gains. Okay? Capital gains. So why? Because house is your capital. When you bought it, the house is your capital. You might wonder, why is it capital? I mean, that's not money. Well, it's not in money form, but it's physical capital. It's capital in physical form. Okay? So the capital value increased from 150K to 500K. So the net increase is 350K, which is called capital gains. Okay, so capital gain means, so you might wonder, okay, shouldn't it be CG, because no, in economics, the symbol for capital is always K. K for capital, right? And G for gains or growth, right? And of course, the opposite can happen. It can go down. Over 20 years, it can the value of the house can depreciate. And you might wonder, you might say, yeah, wouldn't the value of the house depreciate because the house is getting old? The house is getting old, right? The house is dilapidating. I mean, if you don't take care of your property, but most of the times, if you're a homeowner, you don't let your house go dilapidated, right? Don't you think if you're the homeowner, you will take care of your house, you will maintain your house to keep its market value, right? To maintain its market value. Isn't that right? And if something breaks down, you fix it. If there's a plumbing problem, you fix it. You call a plumber, you fix it. If the paints get cracked, you repaint it, right? If the tiles crack, you replace the tiles. Those things keep the house value, right? At the current level, at least. But if it raises the house value, what do you think is the main reason? Over time, over 20 years, house value increased this much.
I feel like one of the reasons on why the house prices may be rising, I want to use a clear example of Florida state. For example, a couple of years ago when me and my family were thinking of getting a house in Florida, it was a lot cheaper. So it was 150K because a lot of people were not living in Florida because of, they didn't have enough good colleges, they didn't have any other things that are provided in New York, for example. And after a couple of years after COVID-19 hit, a lot of people actually start moving out of New York State because it was too expensive to pay for the rent and other expenses. So a lot of people start moving to like Florida State. So I noticed that the price for the houses rose increasingly. So now that if I want to buy a house in Florida, it's a lot expensive than it was before because now a lot of people don't want to live here because of the expenses that are rising here. So a lot of people are moving to different states.
Okay, so and who was that?
Malika?
Malika?
Yes.
Okay, Malika. That was a good answer, Malika. But you see, um, you did you say border state or Florida? Did you say border state?
No, like the states that are Florida, for example, New
Florida.
Jersey, and like
Yeah,
other
yeah, yeah.
states.
Yeah. You people are moved during the pandemic. People moved out of this New York City and moved to neighboring states, or um, like to New Jersey, or they would move out to like uh, uh, suburban counties, like Westchester County, or Putnam County, or um, they moved to uh, Suffolk County, Nassau County, Suffolk County, Long Island. And as people moved into those communities, the house values in those communities went up. Why? Because it's simply demand,
Professor,
right? Yeah, yeah,
I
yeah.
would also say Texas as well, because
Yeah,
before
yeah, yeah.
it
Well,
wasn't a very popular state, but now the prices are going up.
yeah, yeah. That's also that's one good, one important factor. I mean, um, taxes, right? You would move to a state where taxes are lower, or not necessarily a state, but to a community or to a county, right? Uh, so Malika, I gave you 1 point, and who just said that? Darlene,
Yes,
yeah, I'm gonna give you 0.5. That's a very valid point. Taxes, and I see some people dropping lines uh, in the chat box, but I cannot see them all at the same time. So Kyle, I see your hand, but just give me a second. So inflation, home improvement, high demand will increase the value of homes. Yeah, Yang. Yeah, good point. But I would prefer you to say that rather than, because it's Yang, I'm going to give you 0.5. But Yang, you made a very good point. High demand. High demand. Okay, so actually I should give you 1 point, Yang. Um, Darlene, and demand for the houses as well. Yeah, um, demand demand is a very important factor. Kyle, you can lower your hand. You have something to say, Kyle?
Yeah, I just wanted to add on, if we're looking at the span of 20 years, wouldn't the state's or the city's local infrastructure play a major part in the value of the
Oh
property?
yeah, infrastructure. Uh, I was able to you know make out what you were saying, but sometimes you might need to raise your microphone volume, because sometimes it's not very it doesn't sound very intelligible, uh, because there could be some it's unclear, right? And sometimes it's mainly because your microphone volume is not high enough. Um, yeah, Kyle, that was Kyle. Kyle, infrastructure, good point. Um, if you live in a community where, I mean, there's a reason why the homes in the major cities, house values in the major cities are higher than the house values in the suburban area, or a rural area, or in the countryside. Why? It's the demand, it's the population. There's more population in the cities, and the supply of available homes is limited. Isn't that right? If there are 1 million people looking for houses and there are 1 million houses that are available in the market, right? There will be no competition. But if there are 1 million people looking for homes and only 500,000 houses are available in the market, the house value will have to go up, right? Because of the strong demand. And obviously in the city, and you all know, what does the city offer? Infrastructure. I mean, in the city, if you go to the rural areas, you cannot find even, restaurants. You would have to go to a restaurant in the, excuse me, there could be a diner. There could be a diner in the main street in the main township in the county. But otherwise, it's really hard to find diners or eateries, and nothing like nothing like Walmart, or nothing like Target, or nothing like malls. I mean, you can find it in the main township of that county, but if you're living in the rural area, you'll have to drive like 1 hour to get there. So immigration, increasing birth rate, improved the transportation. Yeah, look, improved transportation, better transportation, like mass transit. Clearly, that's infrastructure, right? That's infrastructure. And but you can tell. But the thing is, if you compare the quality of the homes for the same price level between the city and the major cities and in the suburb, you will see there's a drastic the value for money is a lot higher in the suburb, right? For example, what kind of condo, or what kind of house can you buy in New York City with $300,000? You can't find any in especially in Manhattan. You can find, maybe you will be able to find 1 bedroom apartment, not a rental building, but a condominium, or a for $300,000. Maybe you can find something in the 5 boroughs. But it won't be very fancy. It would be very small apartment that was built in the early 20th century. Sometimes no elevators. You are living on the 5th floor, no elevators, and everything, it was built already a century ago. So everything is really, really crappy, very crabby. First of all, very small. And the kitchen cabinets, bathrooms, everything is very old. The materials are already very old. Okay. But for $300,000 in the suburb, you can buy a home. You can afford something much better, right? But I'm not gonna talk about it anymore, because that's not the point. The point is, even if it is back to the house value goes up if the population increases, right? Population increases, because population increase will increase the demand. And if the demand goes up, even a very crappy, apartment in Queens or in the Bronx or in Brooklyn will still go for more than $300,000, right? Because of the demand. And also the same, the opposite goes for the reason for the house price depreciation. In the areas, you can, if you, I don't know if you ever go out of, if you ever travel out of the city to some old towns, old townships in New York State or in Pennsylvania or in New Jersey, old towns, the towns that thrived, small towns, the towns that thrived even in mid 20th century, like 1950s, 60s, even up to 70s. Those old towns, you can tell that those towns are dying these days. By 21st century, these towns are dying. Why? No young people there. Mainly, the residents there are old grandpas, old grandmas, who own their homes there, and they're gonna probably pass away in the homes that they live, and then after that, if they have children, they will not move back into those houses. They will sell them off, right? They will sell them off, and they will, and they have already moved in. They have moved out, after maybe when they were after graduating from college and got a job in major cities. They moved to major cities, so they aren't going to be moving back into these old towns. But so these old towns are really dying. You can see they are at the verge of disappearing. There are lots of small towns like that. Did someone say something, or was it my voice just echoing? So if there's, and those towns on demise, right? Towns declining, old towns, the house values would go down because there's no demand. Nobody is.
Professor, can you turn up your volume?
You turn off my volume? What do you mean? Am I too loud?
No, turn it up. You just
Turn it
went
up.
very low. Yeah, turn
Okay.
it up.
I don't know. I mean, this is.
Can hear you better now.
Oh, okay. So it's just I think I need to move in closer. So you see what the point is the demand, right? If the demand goes up, if the demand is strong or demand goes up, right, the price of everything goes up. Now, I wrote it like this. I mean, I put 2000 price 2001 first on top, and then price 2021 at the bottom. So the arrow goes down, but that doesn't mean this arrow. It's just because I put the earlier price first, right? But actually price went up, right? This is the price appreciation, right? So think about it. So how do we understand the return? I mean, what is when you bought the house, maybe you didn't have any intention of, you didn't think this was an investment, but inevitably it's an investment. There's a reason why people want to buy homes in the place where if possible, you don't want to buy a house in a remote, wilderness. Of course, if you're a loner, I want to be isolated from the civilization. I want to live. Yeah, you can do that. You can go to states like Wyoming or Idaho, Wyoming, and live in the wilderness, or Alaska, live in the wilderness. Completely isolated from the civilization. But generally, if you there's a lot of inconvenience if you live in isolation. First of all, there's no infrastructure there. If you live in the wilderness, think about it. There's no electricity. Nobody brings the power line there just for you. You have to do it. You provide it yourself. Oh, heating, right? Gas line. You have to. If you live in the wilderness, there's no infrastructure like pipelines, or power cables there, right? And even though it may not be your original intention, but it's inevitable. When you buy a house, you cannot ignore the investment aspect of that house, right? As long as you live in the house, you don't want the value of that house to go down. Isn't that right? Because you never know when you might need to sell the house, and when you have to sell the house, you want to sell it at a price that is higher than the price you paid. Isn't that right? Did everyone hear me?
Absolutely want to sell it at a higher price. Yes.
Yes, of course. Yes. Thank you for acknowledging. Who was that? Who said that?
That was Stephen.
Stephen, yes, definitely. Stephen, I'll give you 0.5 for being responsive, right? Yes, absolutely. You want, so inevitably, whether you like it or not, there is an investment aspect in the when you own a property. Then think about it. Let's think about the return on investment in this case. How do you calculate the return on investment? Well, of course, this part, the capital gains, this is what you got for investing. Originally, you invested. What did you invest originally? You originally invested 150K, right? You originally invested 150K. So that's your initial investment, right? And the return from investment was 350K, right? So and the return on investment is actually percentage rate. In other words, when we say return, it must be expressed always as percentage. Okay, what do you call this? That's called capital gains. Okay, what do you call 350? It's called capital gains. Okay, just to make it easier for you to understand, I called it return from this investment. I call this return, this 350K return, but return is not expressed in dollars. Return is always expressed in percentage. Okay, so return on investment, to calculate return on investment in this case, price at the time you sold it, right? The price you sold it for and the price you paid.
Would that be the net profit, Professor?
What's that?
Would that be the net?
You can consider that as profit. You can consider that as profit, but again, it's not profit is not the profit is not the right word in this context, because profit is not the right word in this context. As I said, the correct word is capital gains. Okay, so this is the price in 2021. That's at the end of 2021, right? When you sold it. This is the price at the end of 2001. That's the price when you bought it, right? Of course, the difference between the two must be divided by the price that you paid, which is your initial investment, right? And it can be rewritten as, so this difference is called what? Capital gains. Okay, capital gains. And then at the bottom, you divide it by initial investment. Okay, initial investment. Obviously, think about it, because that's the windfall, or that's the fruit. This 350K. 350K is the fruit, right, of your initial investment of 150K, right? This is quite rare. I mean, think about it. In this case, if we actually calculate it, is, think about it, 350 over 150
is 2.3.
Yeah, think about it. It's 35 over 15, that's 3 over 7, right? 7 over 3, that's 2.5, which is 250%. Yeah. 250% net return of 250% net return. Are you sure it's 2.5? 3, it's 3, no.
2.3.
2.3, yeah, 2.3. So 2 point, it's almost like 233% net return. Net in gross terms, right? If you in gross terms, it's going to be 333. Why? Gross means, think about it. Capital gains is the net return from the investment, right? The gross return would be 333%, because from 150, right? Okay. It's 500K over 150K, right? It went from 150 to 500. So the net return, if you calculate it, it's going to be 333.33. What's the difference between the gross return and net return? Gross return includes the initial investment itself. In other words, investment is like a tree, and then suppose you are, think about it. Suppose you are a farmer or orchard owner, and you have you bought an apple tree. And the apple tree will bear fruit in the fall. Now you paid, let's say this is like you paid 10K for this apple tree. And in the fall, so the value of this apple tree itself is 10K. And in the fall, it's going to bear a lot of apples, right? There will be a lot of apples on the tree. Okay. Now, the value of the apples alone, let's say is 20K. Value of the apples alone is 20K. Then the return from this tree, which is the output of this tree, is 20K. Isn't that right? And then what you invested in this tree was 10K. So if you are calculating return on investment, then it should be 20K over 10K, right? Which is, 200%. But if you're selling this tree to someone, right? If you're selling this tree to someone, then it's not only the value of the apple you will charge, but you will sell also the tree. So the whole thing, what you receive in payment will be 30K, right? If you want to calculate the gross return, $30K over 10K, so then that's going to be 300%. This is going to be 200%. In other words, the difference between the net return, and gross return is simply itself, right? The investment instrument itself. In other words, whether you include the original investment instrument, right? The original property in our house value example, whether you do that or not, that makes the difference between the net return and gross return. Okay, and okay, let me. All right, so I think here's one thing I have to, one thing I want to make clear. Return on investment is rate of return. Rate means it's the percentage, right? Rate means percentage. So all returns must be expressed as percentage, right? Dollar return is people just by habit. People say, my return was 350K. No, that's just what they do by habit. When you say, if you want to express that, like if you express it as return, if you say return, it must be in percentage. And if you say 350K, like in dollars, then it must be you should say that the profit was 350K, or the proceeds. Proceeds means when you sell and receive payment, that's called proceeds. Proceeds was 350K, right? Or capital gain was 350K. Okay, so make a clear distinction. Return is always rate of return. Return means rate of return, and it must be in percentage. Okay, all righty. So it's been. Oh, I was. Normally, I give a 10-minute break between every after every 50 minutes, but we went on almost 1 hour 30 minutes without a break. So I think this is a good time to take a break. And since our class is until 2:30, let's see. I mean, we may take like a 20-minute break and then continue without any break until 2:30, or we may take a 10-minute break and another 10-minute break at some time later. How does that sound? I mean, which one sounds better? Or do we take 20-minute break?
Yeah, for me, the 20-minute break.
Okay, all righty. So let's take a 20-minute break, and let's say it's 1:23, but let's say approximately 1:25. And so take 20 minutes and reconvene at 1:45. Okay?
Okay.
All righty. So let's take a 20-minute break, reconvene at 1:45. All righty. So let me go silent. All right, we're back. I hope everyone is back too.
I'm back.
Okay, good. Darlene, you're here.
And
Hi, Yang. So I see you're here back, and I would. Okay, Kazuki is here,
I'm here.
obviously. Yeah. Okay, good. So I will assume that everyone is back now. So let's take a look at the. Okay, this file. Let's do this exercise. Basically, it's pretty much, the same thing as the example I have used so far. So this is, everyone should know what file it is. It is the one, it's this one, right? So I want everyone to download it and have it in front of you. So do you have this file opened in front of you? Please confirm.
Yes.
Yes,
Okay,
sir.
good, Stephen. Andrea, good.
Yes, Professor.
Angel, you have this file in
Yes.
front of you? Good, good. Darlene, you have this file in front of you, Darlene?
Yes.
Okay, good. Gary, do you have this file in front of you?
Yes, I do.
Good, good. Kyle, do you have it in front of you? Kyle? Leslie?
Yeah.
Yeah, okay, good.
Yes,
Leslie,
Professor.
okay, good. You have
I
this
have it
file in
too.
front of you, right? Malika, yeah, good. Randy, do you have this file in front of you, Randy?
Can't even see
Randy? Stephen, do you have this file in front of you? You said already. You said,
Yes, sir.
right? I got
Correct.
you. I got it. All righty. So let's take a look at this file you have. So this is exactly like our example, right? Isn't that right? Um, at the end of 2005, you bought this house, right? For 150K. By the end of 2016, you sold this house for 500K. Oh, okay. So this is exactly our example, except that our timeline is a little different. That's fine. It doesn't matter. This timeline, in other words, the time during which you were holding that asset, the house is an asset, right?
I'm
Just
sorry,
like,
Professor. I would just
yeah.
like to check. Can anyone see what he's sharing, or it's just my screen?
Oh, am I not?
we can
Yeah,
see
I
that.
can I can see the Excel document.
So you see, so everyone sees this Excel file because I'm sharing the screen now.
I can see it. I can see it too.
Okay. So everyone can see this now, right?
I can see it.
Malika?
I can see
Yeah?
it, yes.
Okay, good, good, good. So yeah, I'm sure yeah, I'm sharing this file. This means, yeah, I'm sharing this file. All righty, so holding period. First of all, here, the holding period can be any length of time. I mean, you can hold any asset. For example, you buy a stock. You buy a stock today and sell it even tomorrow. You buy a stock today, sell it a week later. You buy a stock today and sell it a year later. No matter when you sell it, right? Um, it doesn't matter, but the time during which you are holding that asset is called holding period. Literally, yeah, that's because that's the time during which you are holding that asset. Okay. Now here, another thing, asset. I'm gonna have to redefine. I'm gonna have to define asset later on. Um, but a house is an asset, um, just like stocks and bonds. And before I threw this house value example to you, I said investment instrument can be not only financial instruments like stocks and bonds, but also real estate or art, fine arts, right? I mean, some people, art collectors, they buy at auctions, very expensive art pieces, right? Paintings or sculptures, Why do they buy it? Of course, they can buy it simply because there are art aficionados. They are just simply buying it to appreciate the art. But most of the art collectors are also investors. They buy art. So art could be an instrument. Um, uh, and also, among the collectors, a lot of, collectibles like stamps or old cars or many things can be investment instruments, but uh, uh, the difference between these different investment instruments is whether there is a organized exchange, an organized market, organized exchange, right, or not. For example, stocks and bonds, clearly there's an organized exchange, organized market. You can only buy and sell stocks through organized exchange. And real estate, of course, there's a market for real estate, right? And when there is a market or exchange for these investment instruments, then the valuation becomes relatively uh, uh, more transparent. Valuation can be more transparent, right? Valuation can be more objective and transparent. Whereas if there is no officially organized exchange, then or market, then the valuation is really subjective. Think about it. I can't understand, especially if it is art, right? In the market for art, it's usually auction, and sometimes it's hard to understand why it sells at that value. They say it's Van Gogh. Yeah, Van Gogh is a well-known, um, celebrated, Dutch, Dutch and French, painter, artist, of the 19th century. His arts, his paintings, go for millions of dollars. But yeah, there's a lot, consensus about that. But modern art, I really don't. Uh, uh, it's really hard to understand, why for non-art aficionados, so it's personal taste. It's a matter of personal taste, really. So there's hardly any objective basis for valuation for something like that. But at least for financial instruments and real estate, yeah, there is a very objective and uh, very objective criteria or basis for valuation. Um, So let's take a look at the first column. Every the data, a second column B is the house price, right? And then these data were collected at the end of the year. So this is the house value as of the end of the year, every year, right? So why? Think about it. It has to be uniform, consistent and uniform. In other words, you cannot use middle of the house value at some point, and they must be uniformly data collected at the end of the year, because if they are not, if any one of them is not as of the end of the year, then the consistency and uniformity of the data will break down, and we cannot use that. We cannot use that kind of data series. The data series must contain the data of uniform consistency. Okay, so it's always, for convenience sake, we are using end of the year data. And of course, we don't necessarily buy and sell the house at the end of the year. That's not realistic. But just for our thought experiment, we will assume that we bought it at the end of the year price and we sell it at the end of the year price. Okay? And the holding period is 11 years, as you can see. You might wonder, isn't it 12 years? No. Why? In 2005, we didn't own the house. Right? You understand? This is the end of 2005 price. So we didn't have the house during 2005. If this is the beginning of the 2005 price, then this is also the beginning of the year 2016. It has to be all consistent, uniform and consistent. Then still 11 years, right? So now you understand why it's not 12 years, but and also end of the year is the same thing as the beginning of the year. Isn't it right? End of the year is the same thing as the beginning of the year, right? So end of 2005 price is the same thing as beginning of 2006 price. Does that make sense? Why? Because think about it. Midnight, probably, I don't know how many of you were awake watching the ball drop. I don't know. I didn't watch. I slept on December 31st at midnight. I was sleeping, and I didn't even care whether the ball dropped in Times Square or not. It doesn't matter. It's pandemic. Who's crazy enough to go there? It's not something to risk your life to, I don't care. I mean, every year, at end of every year, the ball drops, anyway, in Times Square. It's not, So I was sleeping. Did anybody watch anything? Was there a ball drop on December 31st?
Yes, I was watching.
Oh, okay. All righty. So
dropped, but it was different from every other year because other places were also having celebration. They had a celebration in New Orleans, and it was like on television at the same time, on a different screen. So it was New York, New Orleans, and I believe Atlanta.
Oh, I'm sorry. You were in Atlanta? That's fine. I thought you were saying, you were either watching, what's going on in Atlanta, or you were in Atlanta. But the thing is, when the clock strikes, think about it. End of 2021, when the ball drops, that's 12 midnight, but at the same time, that's the 0 hour, 12 a.m., 0 hour of 2002. Isn't that right? End of the year is the same thing as the beginning of the next year.
Yes.
Right? So that's the concept. So this is the end of 2005 price, which is the same thing as the beginning of 2006 price. This is the end of 2006 price, which is the same thing as beginning of 2007. But to make it simple, we'll call it all end of the year, because think about it. The reason that we use end of the year data, end of the year house price, is because end of the year price is the conclusion of that year. Isn't that right? Conclusion. That's what's important. No matter at what point it started, for example, in 2006, the price started at 150K, but that's irrelevant for 2006 because conclusion of 2006 price is the end of 2006 price, 880K. So this is the reason why I use the end of the year price, because that's the conclusion of the day. The same thing for stock price as well. Every day stock market opens at 9:30 a.m., closes at 4 p.m. Now, when the market opens, the stock price opens. There are stock price opens at the first trading, right? The opening trading. At the opening trading, the opening price will be determined. But then think about it. During the day, during the trading of the day, there will be 4 price points, right? There will be 4 price points, don't you think? 4 price points. First, opening, and then closing, and then in between, the highest price of the day and the lowest price of the day. Isn't it right? There will be 4 price points during the trading of the stock market. Everyone understands that. Isn't that right?
Correct.
Yeah.
Yeah. But think about it. What price of those 4 price points, what price represents the day's trading?
Would it be the last one?
Yeah. End of the day. Who said that?
Randy.
Randy. Okay. Randy, yeah, you'll get 0.5 for that answer. Yes. It will be the end of the day price. In other words, closing price. Closing price. Why? Because that's the conclusion of the trading of the day. Isn't it right? No matter where it opened, no matter where it opened, or how high it reached, or how low it reached during the day, it's all irrelevant. The conclusion of the trading of the day, conclusion of the day's trading is always captured or represented by the end of the day closing price, right? So that's why we use the end of the year data, house values during the year. You will have 4 price points during the year: opening, closing, right? And highest during the year, lowest during the year. But all of that, 3 of them, right? 3 of them are irrelevant. Eventually, what concludes the house value of that year is the end of the year, right? So what this means is, some of the cash flows, but I'm going to get to that. Here's cash flow. Now, also think about it. When you buy a house, there are 2 ways. I mean, 2 purposes. There can be 2 purposes, right? When you buy a house, there can be 2 purposes. One, you buy it for your residence. You buy it as your home. You're gonna live in that house, so that's gonna be your home. So there's no cash flow from the house until you sell it. When you sell it, then there will be a cash inflow. Isn't that right? When you sell it, then you bought it for 150K, bought it for 150K. So at the end, you sold it for 500K. So the in this case, the only cash flow is the capital gains, right? Capital gains for 11 years, over 11-year holding period. But the second purpose when you buy a house is a rental property. You can buy a house with an intention to rent it out, rental property. So if you bought a house, it's a 3-story, 6-bedroom, 3-bathroom, 6-bedroom, 3-bathroom house, or whatever, 3 kitchens. It's a big house then. Then you can rent this out, right? I mean, you can use, one floor for yourself and rent out the other 2 floors. Each floor has, 2 bedrooms, 1 bathroom, 1 kitchen, and you can definitely rent this out. And if you rent it out, then there will be additional income, additional cash flow called, rental income, right? So we can think of 2 scenarios, right? Scenario one, where you buy, in scenario one, you buy this house as your home, as your residence, primary residence. So in that case, there will be only capital gain. The only cash flow in that case is the capital gain. Okay, and we know the capital gain in that case, we can simply find it by simply, simply by taking the difference between the 2, isn't it right? Right? Taking the difference between the 2. Okay. Now I just showed you how you do that, and it's it's not difficult. You can also I want you to do that too, right? By subtract from B2, subtracting B13 from B2, right? Of course, you should start with equal sign, right? And B2, you don't have to manually enter it. You don't have to manually type in B2, B13. You can just click with your mouse. You can click it in. Select a cell, click in. Select a cell, click in. Okay. So capital gains, which is the cash flow, the only cash flow in scenario one, right? There will be a 350K. Now let's take the capital gains year by year, annual capital gains year by year. So which is what? Then you can simply take the difference between each 2 years, right? You do that, and you don't have to do it one by one. You can just bring your cursor, select the cell, bring your cursor to this corner. I call that southeast, north,
southeast.
Southeast. Yes, southeast corner. That's the southeast corner, right? Or 3 o'clock, southeast corner. And when you place your cursor there, the cursor turns into a thin black cross. Normally the cursor is this fat white cross, and when you bring it to this corner, it turns into a thin black cross. Then that means Excel is ready to copy and paste. So you then just gently hold down the left mouse button. Just gently hold down the left mouse button and just drag it down. And stop here because there's no point in dragging it all the way down here because there's no data here. I mean, this was not the original initial data, right? This I got it, by taking the difference. Then you can see year by year how much the house value changed between end of 2005 and end of 2006. In other words, during 2006, the capital gain was 30K. This is what happened during 2006. And during 2007, actually, house value went down for whatever reason. It could be, actually in 2007 there was housing market crash, into what's called subprime mortgage crisis. In 2007, that's actually what happened. It happened by more than by more than this magnitude, by a huge sheer more than like 30%, 33% magnitude, or even 50% in some. And then 2008, and then you see 2013, the house value dropped during that year, and then 2014, and then 2015 there was no change. I mean, that's possible, right? That's possible. And then so then some Greek character sigma, that means summation. You're summing, this means summing all the prices at time t, where t runs from, let's say, 1 through n. What does that mean? There are n number of years, so there are n number of prices. N number of prices, right? And so as you go from time 1 through time n, year 1 through year n, you're summing up all the prices from year 1 through year n. That's the that's the meaning of this notation, right? That's the meaning of this notation. Okay. Now, so if we sum everything, right? If we sum everything, and we can use, simply go to home, and then you see this summation, right? Sigma. If you click that, it's gonna sum everything above it. It's gonna sum everything above it. It's actually C2 through C12, but it's fine. I mean, it's automatically built to sum everything above it. And since C13, there's no data, it's not gonna affect anything, right? It's gonna sum everything, which is gonna be exactly the same thing, right? They have to be the same thing as the difference between these two, the final value and the initial value, right? Because all the annual differences must add. Now, column D, what is column D? Column D is the rental income. So that's scenario 2. I said we can have 2 scenarios, right? Scenario 1, scenario 2. In scenario 2, you buy the house and rent it out. It's not just your home, but it's a rental property. So there will be additional income. So then for the first 3 years, you didn't rent it out. For the first 3 years, you didn't rent it out. But from the 4th year, you rented out. And the rents were annual. These were annual. So it looks like, monthly was like $1,200, right? And then from the 6th year, there was 10% increase. 10%. And then suddenly, you raised it to $2,000 and 12 months. So it's also easy. I mean, it's the same thing. You can copy this and drag it to the right, because this also sum, right? You see what's in here. I mean, 350 is not in that cell. It's because this, when you look into the cell for the formula, it stretches. The cell stretches. So the formula starts from equal sign, always equal sign. What you see here, 350 is what was originally here. Okay, so all those rental incomes for during those years that you rented out, right? Even including these years, because there was no data. It's 171,600. So now let's think about what is the return on investment, or rate of return, or in this case, holding period return, because during this holding period, what was your total return? Holding period return means also total return during this period. I already got it here, which is simply C14, which is capital gains, right? Over initial investment. Isn't that what we did, here? Isn't that what we defined it as? Again, I would also call it holding period return. Okay, holding period return, which is price that you sold it for, right? And in our example, price of 2016 minus price of price that you paid for 2005, which is capital gains. You divide it by your initial investment, which is 2005 price. So that's what you got. If you do that, it's going to give you automatically, right? It's the same thing, but I can also do it this way. B2 minus B13 divided by initial investment, B13. It's the same thing anyway. It's the same thing. This is the holding period return in scenario one. Scenario one. Okay. Now in scenario two, then how would you find the holding period return? Of course, here it's already done. During the holding period, there were two sources of cash flow. One from the capital gains, right? The other one from the rental income. So capital gains, we already know it's 350K, and during this period, sum of all the rental income, which is this, right? So therefore, the C14 plus D14, then you divide it by initial investment, right? There you go. That's the holding period return, or total return during total return under scenario two. Okay, everyone clearly understands the difference. What's scenario one and what's scenario two, right? Now, it's the same thing, but just to make it clear. First, capital gains, which is this minus this. Okay, and then plus sum of all the rental income, and then you divide it by initial investment, and voila, you should get the same thing. Okay, and then So this is what it means. Okay, holding period return is equal to, holding period return is price at time t plus n minus price at time t plus sum of all the cash flows during the holding period, which runs from time 0 to time n, or time 1 to time n. Time 0, if we, instead of, remember I used the first data in our example was end of 2005, but that's the same thing as the beginning of 2006, right? And if ever we had, if all the data was as of the beginning of the year, right? We could have also had the rental income during the first year, which is, which begins at time 0. So to make it very inclusive, to make it comprehensive and inclusive, I used, time 0 from here. Time subscript. This is called time subscript, right? Time subscript means basically it's a time marker, right? Like, it's a time marker. It's just like when I put 2021, 2001, that's a time marker. It doesn't affect the numerical value of your data. It's just a time marker. Okay, so if price at time t, if time t is now, today, or this year, time t plus n means n years later, right? Makes sense? And if time t is 2005, right? PT means, of course, price at time t. So if t is 2005, P means price at time 2005, at the end of 2005. And then PT plus n, that means n years after 2005, right? If t is 2005. N can be any number, like 11 years after 2005. Then that's going to be price at time 2016. Okay, makes sense. And then this means all the, so this will represent, this will represent the capital gains during the holding period, right? And this represents sum of all the additional income, right? During the holding period. Now, this formula works for both scenario 1 and scenario 2, because think about it, in scenario 1, this term just drops out, because in scenario 1, this term is 0. Makes sense? In scenario 1, this term is simply drops out because it's simply 0, right? All right, then let's think about it. Based on that, okay, so I think we found the holding period return and on the both scenario 1 and scenario 2. Oh, next, let's think about the what is column F and column G. Column F and column G are basically annual growth in house value, and column F is annual growth in house value. column G is annual return. Oh, so how are they different? I'm going to talk about that in the next class. I mean, today, I think we've covered, we have only 5 minutes left, and we cannot uh, fully discuss the difference between growth rate and return. So we're going to talk about this tomorrow. Okay, we'll all. Any questions so far? Any questions? Any questions?
Yes, I have a question, Professor.
Yeah, darling. Yeah.
Do we need the textbook for this class?
Yeah, I didn't post anything about the textbook, but during the regular semester, the textbook is mainly needed for the Connect chapter problems. But during the winter, it's just 3 weeks. There's no time for that. So you won't need a textbook because we're not going to do any Connect chapter problems. But if you need, if you want to, my lecture notes are relatively void of any verbiage because I don't like verbiage. It has verbiage, but very minimal. So if you want, some people need to, some people feel complete only when they have some verbiage, right? So if you want some reader, yes, I would tell you, I will post information about the textbook, and you can get it from the BMCC bookstore. I think it's the easiest way.
If we don't need it,
Just
I won't purchase it if we don't need it.
okay.
Yeah.
Well, yeah, it's up to you. As I said, some people need some verbiage, and people who need verbiage, I would, I would recommend. But if you don't need any verbiage, it's fine. You don't, and it's, 3 weeks. You won't have time to struggle with verbiage. I mean, you have a lot of things to struggle with, right? More important things than the verbiage. So, yeah, but I will still post the information about the textbook, okay? Just in case. Any other questions? Any other questions?
I have a question about the quiz.
Yeah.
So what is the format of the quiz and exam? Is it ABCD or
Yeah, it's gonna be a combination. I mean, it's gonna be a combination, but you will see. I mean, it will be some combination of multiple choice and short answer, but mathematical answers, right? Mathematical answer. So you will see that.
So it's on Blackboard, right?
Yeah, it's going to be posted on the Blackboard. It's going to be posted on the Blackboard, and you will be notified in advance, like at least 2 days in advance. But there will be, so as I said, your exam will be, there will be 4 exams. There will be 4 exams throughout the term, and those 4 exams will be the main determinants. But other than those 4 exams, quiz 1, quiz 2, midterm final. Now, quiz 1 and quiz 2 are not necessarily pop-up quiz. They are elaborate, really elaborated exam. In other words, fully fledged, fully developed, fully fledged exams. I just call them quiz because they carry slightly lower weight than midterm and final, 5% less weight. But before that, there will be a practice test. So in a way, self-diagnostic test, practice test. And before everything, you will be notified in advance. Okay. All righty. Any other questions? All right. If you don't have any further questions, then let's call it a day. Have a great afternoon, everyone. And I will see you guys all back tomorrow at 12. Okay?
All right.
All
Thank
righty.
you, sir.
All right. Take care, everyone. Take care.
Thank you. Bye. God bless you.
All right. All right. Take care. I will see you guys tomorrow. Okay? I'll stop sharing, stop recording.